Welcome to 2026. The world of finance has undergone a tectonic shift. What worked in the 2010s, the era of near-zero interest rates, is now ancient history. Today, we are building a strategy for the new economy. Starting to invest doesn't have to be a gamble. In fact, for a beginner in 2026, the safest way to start is by building what we call a financial fortress. A systematic, automated, and low-risk foundation. We are now in a higher-for-longer interest rate environment. This means that for the first time in a decade, cash and safe bonds are actually working for you, not against you. We'll show you how to leverage this. Artificial intelligence is the engine of the 2026 market. While it creates massive growth in tech, it also brings new volatility. Safety today is about finding the balance between participating in this growth and protecting your capital. In this guide, we define safety through three pillars: capital preservation, predictable returns, and low volatility. We aren't here for the moonshots. We are here for the fortress. Step 1. Eliminate bad debt. In 2026, credit card interest rates have remained stubbornly high. Paying off a card at 20% is the single best investment you can make. It's a guaranteed return. Think about the math. If you are paying 22% on debt but earning 10% in the market, you are losing 12% every single year. You cannot build a fortress on a sinking foundation. Next, calculate your monthly survival number. This is the bare minimum you need to survive. No luxuries, just the essentials. Knowing this number is the key to true financial peace. Multiply that number by 6. This is your emergency fund. In 2026, with the rapid shifts in the AI-driven job market, a 6-month cushion is no longer a luxury. It is a survival requirement for any safe investor. Where do you store it? High-yield savings accounts. In 2026, these are finally beating inflation comfortably. They are FDIC insured, meaning your principal is safe up to $250,000. If you want slightly higher yields with similar safety, look at money market funds. They invest in short-term government debt and are a staple for the safe 2026 portfolio. The most successful investors in 2026 don't use willpower. They use automation. Set up a recurring transfer from your bank. If you don't see the money, you won't spend it. It's the habit that builds wealth. This is called dollar cost averaging. You buy more when prices are low and less when they are high. Over time, this drastically reduces your risk and removes the stress of trying to time the market. Phase 2 is choosing your vehicle. In 2026, the taxman is more active than ever. Where you put your money is just as important as what you buy. Taxes can eat up to 30% of your growth if you're not careful. Always start with your employer-sponsored plan, like a 401k. If they offer a match, that is a 100% return on your money on day one. It is the only free lunch in finance. Use it. Invest exactly enough to get the full match. Any less is leaving thousands of dollars of future wealth on the table. This is the bedrock of your tax-advantaged fortress. Next is the Roth IRA. For beginners in 2026, this is the gold standard. You pay taxes now at today's rates, and every dollar of growth is yours to keep, completely tax-free in the future. As of 2026, contribution limits have increased. Aim to max this out after your employer match. It protects you from the risk of future tax hikes, which is a major concern in this decade. If you've maxed out those accounts, then you can move to a standard brokerage account. Modern platforms now offer fractional shares, meaning you can own a piece of the world's largest companies with just $1. Phase 3. Asset selection. Now we choose what goes inside your vehicles. In 2026, we prioritize capital preservation. We want assets that sleep well at night, so you can too. Consider a CD ladder. You buy certificates of deposit with staggered end dates. This ensures that you always have a chunk of cash becoming liquid every few months while you lock in high fixed rates for the rest. U.S. Treasury bills and notes are the safest investments on the planet. They are backed by the government. In 2026, they are a critical tool for preserving your principal while earning a respectable yield. Treasuries are perfect for money you might need in the next 1 to 5 years. They offer peace of mind that your initial investment is 100% protected from market crashes. For long-term growth, we use S&P 500 index funds. Instead of trying to pick the next Apple or Nvidia, you simply buy them all. This is instant, automatic diversification for the 2026 investor. Individual companies can go to zero, but the top 500 companies as a whole have historically recovered from every single market crash. In 2026, this is the ultimate set-it-and-forget-it strategy. A safe starter portfolio in 2026 might look like this: 30% in high-yield savings for liquidity, 40% in U.S. index funds, 15% in international stocks, and 15% in safe government bonds. Phase 4 is the mental game. In 2026, information moves faster than ever. The biggest risk to your wealth isn't a market crash, it's your own reaction to a scary headline. Avoid the hype trains. Whether it's a new AI coin or a disruptive biotech stock, don't let FOMO, fear of missing out, ruin your strategy. Stick to your core, diversified assets first. Market corrections are a feature, not a bug. They happen. A safe investor doesn't panic on a red day, they see it as a sale. If your strategy is solid, time is your greatest ally. Never underestimate the power of compound interest. In 2026, starting with even $50 a month can grow into a massive sum over decades. The key is to start as early as possible. Once a year, rebalance your fortress. If your stocks grew too much and now make up 70% of your portfolio, sell some and move it back into bonds or savings to keep your risk level safe. Watch the fees. They are the silent killer of wealth. In 2026, there is no reason to pay high management fees. Look for index funds with expense ratios near zero to keep your money working for you. Choose your platform wisely. In 2026, security is paramount. Look for established brokers with two-factor authentication and a long track record of protecting user data. Safety starts at the login screen. Be aware of AI-driven scams. If an investment promises guaranteed high returns or uses a celebrity deepfake to sell you a dream, it's a scam. Safe investing is usually boring. If it's exciting, be careful. Let's recap your 2026 roadmap. Pay off your high-interest debt. Build a 6-month survival fund in an HYSA. Secure your employer match. And automate your diversified index fund buys. Simple, safe, and effective. In an era of instant gratification, your greatest edge is patience. Safe investing is a marathon, not a sprint. The people who win in 2026 are the ones who can stay the course for 20 years. You now have the tools and the plan to build your own financial fortress. You don't need a finance degree or $1 million to start. You just need the discipline to take the first step today. Your future self will thank you for the foundation you build today. Stay disciplined, stay diversified, and stay the course. The road to wealth is paved with consistency. Thank you for watching. Build your fortress, secure your future, and I'll see you at the finish line. Take that first step now. Good luck on your investment journey. You've got this.